Are you feeling insecure about investing in the stock market? Are you wondering if now is the right time to invest, or do you think a crash can happen at any time? I get you. Believe me, you're not the only one thinking this. For one, because all markets are at their all-time highs, looking at things like PE ratios. But also because news is biased towards negativity. So the articles that you read, the videos that you see, all of them thrive on clicks, and clicks thrive on being negative. So the world that you see and read online is not the actual world. Every day you read one more story, you see one more video about the crash that is happening right now, all for clickbait and not because it's reality. So I am here to give you some actual data about market crashes and to show you what happens even if a crash would happen and you would have invested right before the crash at the worst possible time. In the last 100 years, there have been 8 major crashes or large world events, and I'm going to show you how the stock market was affected by them, how much they dipped, and how long it took for the market to recover. You will see how much uncertainty was in the market, and with this information you can decide for yourself what the best thing is that you can do with your money knowing all these facts. I'm not going to waste your time and give you a summary of all these 8 large world events right now. So in 2029, the Great Depression hit, where the stock market dipped for several years in a row, double digits. And it actually took 25 years to recover, being at the same level as it was before. In 1939, World War II started, and it took the market 6 years to recover after that crash. In 1954, the Vietnam War started, and again it took the market 6 years to recover. In 1965, the Vietnam War intensified, specifically by the USA, but there was no crash, so nothing to recover from. In 1987, Black Monday happened, a big crash that dropped everything like a brick, but it still only took 1 year for the market to recover. In 2000, the dot-com bubble burst, and it took the market 8 years to recover from that all-time high. In 2008, the biggest financial crisis in the world hit every country, and it took 6 years to recover from that crisis. And in 2020, COVID hit, but there was no real crash. So based on this data over the last 100 years, investing has always been a good choice if you can wait for 30 years or longer. And to be honest, most of the time if you can invest for 10 years or longer, you would have been good, regardless of whether you invested right before a major crash happened. So there you go. Crisis or not, if you keep investing, you will get solid returns over time. Now there's a lot of nuance to these 8 large world events. There's even a time when 2 of them follow up in rapid succession. Also, there's one that looks a lot like the stock market today right before the crash. And if you want to understand the nuance of each of these events, how to make the most of it, then sit back and watch and let me tell you the story of the 8 largest world events over the last 100 years and how the stock market reacted to them and how you can use this information to get the best return for yourself. In 1929, the Great Depression started, for which 3 years in a row the stock market dipped double digits. For the S&P 500, over 10 years, your $100 would turn into $54. In 20 years, it would turn into $62. And it would actually take you 25 years to get back to your initial $100. But what if you didn't invest once right before the market crashed, but instead you invested $100 before the market crashed, and then $100 for every year after that for 10 years in a row? In the S&P 500, that $1,000 would have turned into $1,125 at the end of the 10-year period. That gives you an average CAGR of 1.18%. Otherwise mentioned as the growth per year over the 10-year period would be 1.18% every year. Now, wait. Big disclaimer here before you start ranting off. I know that this is not 100% accurate because you invest $100 every year and not all at once, but I want to keep the math simple. So you made $1,125, you invested $1,000, so your profit is $129, divided by those 10 years is a CAGR of 1.18%. Let's keep the math simple. A much better return than just investing $100 once, but still not great if you compare it to the average return of the stock market, which is between 7 to 10%. The next big event is in 1939 when World War II starts. Again, stock markets dip for 3 years in a row, just like during the Great Depression. If you invested $100 in the year the market crashed, your returns would be $115 in 10 years or $418 in 20 years. In total, it only took 6 years to get back to that initial $100, and from there on, things go up and up. The results for the Dow Jones are really similar. This means if you invested right before the World War II, right before the crash, it would have still given you positive results, even though the results aren't great, but you would still have made a profit. If you left it in the market longer, for 20 years, you would have a CAGR of 7.41%, which is great and average. So the longer you leave your money in the market, the more it reverts back to the average and the better it is for you. If you invested $100 for 10 years in a row ever since World War II started, you would now have $1,259 with the S&P 500 or $1,213 in the Dow Jones. A much better return than during the Great Depression, although not great and not average for a 10-year period. In 1954, the Vietnam War starts, but markets really didn't respond to it. If you invested $100 in the year the war started, your returns would have actually been amazing. For the S&P 500, after 10 years, you would have $302. In 20 years, you would have $393. No crashes, no issues. If you invested $100 for 10 years straight right when the war started, you would have $1,708 at the end of that 10 years for the S&P or $1,533 for the Dow Jones. Those are below average returns for the market, and there are actually worse returns than just investing the $100 once right before the war started. Meaning that the later years of that decade were actually worse than at the start of the war. In 1965, the Vietnam War is still going, but the USA intensifies their commitment to it. And that meant stock markets went all over the place. If you invested $100 right before the war intensifies, your returns would be as follows. The S&P 500 would have given you $81 back. In 20 years, that $100 would have turned into $197. If you invested right before the Vietnam War intensified for the USA, you would have made your money back in 3 years. In 1987, we have Black Monday, which dropped all markets like a brick. The S&P 500 returned in 10 years $306 with 11.83 CAGR, which is really impressive. If you invested right before Black Monday crash, you still would have made your money back in only 1 year. If you invested in the Europe 600, the 10 years would have brought you $262. If you average it out to 20 years, it comes to $668. The Nasdaq also did very well. In 10 years, that $100 would have been $370, and in 20 years, it would have been $692. The Dow Jones as well. In 10 years, it would have brought $340, and in 20 years, $657. And mind you, that after Black Monday, all indexes only took 1 year to recover. So after one really bad year, all indexes recovered and you would have made your $100 back or better. As you can see, during the decade that followed Black Monday, returns are actually pretty solid. And they get even better if you would have invested $100 for 10 years straight. The S&P 500 would put you at $2,099, more than double. The Europe 600 at $2,029. The Nasdaq at $2,600 and the Dow Jones at $2,314. All solid returns for a decade of investing. Then we move over to 2000 when the dot-com bubble bursts. And oh so promising internet companies went down harder than the Nafati brothers when they fought Eddie Hall.
The signal, trying to fight. Becky will go. Lock them down. Ready. The right ready off.
Any company that was focused on the internet had their stock prices grow at an insane rate, way faster than their revenue. And at some point, that all came crashing down in the year 2000. So wait, let me get this straight. In 2000, there was a lot of hype about a new technology that no one really figured out yet, but people were just investing in it like crazy. And if you added simple things like .com to your name, it would just grow insane because people trusted you all of a sudden. And the investments were so big that anyone with a calculator could understand that there's no way to actually make that back in profits. Wow, I mean, sounds somewhat familiar, doesn't it? Anyway, here are the returns for the 4 big indexes. If you invested right before the dot-com bubble burst, in 10 years the S&P would give you $76, but in 20 years it would be $220. The Europe 600 would take your $100 and turn it into $85, but in 20 years turns it into $180. The Nasdaq takes your $100 and turns it into $56, and in 20 years turns it into $221. And finally, the Dow Jones goes from $100 to $91 in a 10-year period, and to $248 in 20 years. It actually only took 8 years for the markets to recover, but then the next crisis hit. So these numbers are kind of skewed for a 10-year period because they involve 2 crises, the dot-com bubble and the financial crisis, which I'll talk about next. If you invested $100 for a 10-year period, the S&P would put you at $1,020, the Europe 600 at $1,035, the Nasdaq at $1,078, and the Dow Jones at $991. As you can see, the returns between 2000 and 2010 were really low. People also refer to this decade as the lost decade, because essentially even if you invested, nothing happened, except setting you up for the next 10 years that would follow. But then again, if you have 2 crises in 10 years' time, what do you expect? And in 2008, right when the markets restored, the next crisis hit, the financial crisis. If you invested $100 right before the crisis hit, in 10 years' time you would have made $182, or a CAGR of 6.17%. For the Europe 600, you would have made $140, for the Nasdaq $260, and for the Dow Jones $186. The market was back to the same level after 6 years, even 5 for the Nasdaq, right after the biggest financial crisis the world has ever seen. Getting back to normal after 6 years of a huge crisis is insane and hopefully gives you an idea of how fast markets can recover. If you would have kept investing, even if you invested right before the crisis and just added $100 every year for the 10 years that follows, your results would have been pretty good. For the S&P 500, that $1,000 would have turned into $1,839. A fantastic decade if you consider that it had the largest financial crisis of the Western world. And then the final crisis is 2020 when COVID hit and no one really knew what to expect. Most countries had measurement in place to restrict people, and even most countries had total shutdowns for days or even weeks. Now I know it's only been a few years, right? 2020 is not that long ago, but I still calculated the returns for all the 4 large indexes. If you invested right before COVID hit, the S&P 500 would turn your $100 into $208 in only a couple years. Pretty great returns for a 5-year period, crisis or not. So this is what the data tells you about all the large crises and world events that happened over the last 100 years. And the data is pretty clear. If you can invest for 20 years or longer, you will make good returns on it. You will get back to the average CAGR of between 7 to 10% growth per year, and you will make it worth your while. So if you're feeling insecure, or you want to wait out a crash that you think will happen but you don't know because no one knows, please don't. Remember that time in the market is better than timing the market, and as long as your horizon is long enough, you will make good returns on your money. Just invest in large index funds, wait, and you're fine.